When the market gives you lemons, how do you make some lemonade? I've got 5 tax planning tips for down markets, that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, at the time I'm recording this, stock market is down in the U.S. about 20% or so, and it doesn't feel good. We don't like it, right? No one likes this, okay? As a seasoned investor and one that's doing comprehensive financial planning, hopefully you have the right perspective, and that right perspective is, listen, this is part of being an investor. The reason you have high returns over the long term is because you expose yourself to the potential for risk in the short term and downturns in the short term. So that's the reward. There's a risk-reward relationship. No one likes it. But from a comprehensive financial planning standpoint, what are some prudent decisions to make right now? Well, certainly there's likely prudent decisions that you need to make in your present financial position, managing cash flow and making sure you've got an emergency fund fully funded, you're managing debt, protection planning, making sure that you're managing risks well. From a tax standpoint though, what are some of the wise things that you should be doing that are just ripe during a down market? The very first one, and we talked about this, we made this call in March of 2020, and I would tell you it right now as well. We did a special episode of our talk show, The Wise Money Show, that airs right here on this channel, 10 a.m. Eastern Time every Saturday morning, and also on podcast as well. We recorded a special show, March of 2020, where we said, listen, this is chaotic. We've never seen anything like this. Instead of panicking, what if you maxed out your 401k right now? What if you had enough cash flow, and hopefully you don't lose your job, lose your income, whatever. You got to make sure this fits within all 6 areas of your financial life. But if it does, double your 401k contribution rate right now so that you can push as much money into the stock market right now at these depressed prices. Now, that was back in 2020. I'd say the same thing right now. Why would I say that? Because I know the market won't go down further from here. Absolutely not. It very well could. Right? Leading up to this, they were calling this the everything bubble. And I was one of those, right? We had the previous bubbles. If you just go back in history, we had an interest rate and inflationary bubble back late 70s, early 80s. We then had a valuation bubble, the tech bubble, and then we had the real estate bubble, right? Well, you've sort of got all those mixed together right now, or we did coming into 2022. And so, guys, this could get a lot worse before it gets better. I don't know. Typically, the market the market is a leading indicator. So the market's going to anticipate that, listen, we've been able to move past some of these headwinds before you're going to be able to see it. All right. That's what I would tell you right now. The first way to take advantage of low markets from a tax planning standpoint is to fund that 401k, fund that Roth IRA, fund that IRA, fund that 529 plan. If you've got the resources and it makes sense in all 6 areas of your financial life, try to contribute even more right now. If you're on track, if cash flow works and you're currently contributing 10% of the 401k, consider contributing 15 or 20%. Try to reach that max earlier in the year with the odds that, well, markets have had an awful start to this year. Maybe at some point there will be a rebound. And when that rebound occurs, I want to have purchased as many shares as possible at the lowest possible price. So tip number 1, contribute more or make that contribution to your retirement account, to your 401k, 403b, your IRA, your Roth IRA, your 529 plan. Second tax planning tip for a down market is consider switching your contributions from pre-tax to Roth. Why would I say that? Roth 401k, Roth IRA, when you make your contribution, there's no tax benefit on that. So that's disappointing. But the growth on those dollars, you can withdraw tax-free as long as you meet the 5-year rule and you're age 59 and a half, okay, which most people, so as long as you withdraw the dollars in retirement, then you're going to be able to draw this growth out tax-free. Well, wait a second. If the stock market, you could argue, was overvalued, okay, and now is average or maybe even below, like undervalued, depends on what happens with earnings here, but likely when we catch that rebound, whether it's later this year, a couple years from now, I don't know, when we catch that rebound and your shares all of a sudden surge in value, do you want all that growth to be taxable, i.e. in a pre-tax account or pre-tax 401k? Or do you want all that growth, that rebound, to happen in a tax-free account? I would argue tax-free, advantage Roth. Depends on your entire financial situation to see if it makes sense for you to be contributing pre-tax or Roth. But if it does, now is the time when markets are volatile, when markets are down, consider shifting from pre-tax contributions to Roth contributions. Further still, consider doing a Roth conversion. That's the third idea. We're helping lots of people with that right now. Again, I mean, what could feel worse? Well, my investments are down and I'm seeing those losses. Okay, that's painful. Well, now I want you to voluntarily pay some tax. Oh my goodness, people must think we're crazy, right? But it again looks at historical data with the market saying, yep, we're going to get blindsided with some surprises and stocks are going to come down. They're going to be volatile over time, okay? But over the long term, stocks tend to double every 9 to 10 years, and you want to be diversified because that ensures that happens even if, international stocks really struggle for a long period of time like they have, or U.S. stocks struggle for a long period of time like they did in the future, and I'm assuming will do at some point again, or small cap struggle for a long period of time. You want to be diversified so you can ensure, hopefully give yourself the best chance of that doubling happening every 8, 9, 10 years, something like that. But valuations are down, stock prices are down, and therefore you could voluntarily choose to pay some tax on some of your pre-tax accounts and pre-tax dollars, shift them over to a Roth IRA or the Roth 401k. Again, that's a taxable event. You've got to pay tax on that. But then you've got those dollars represented in shares in a Roth IRA, and when the valuations, when the rebound occurs and when those shares become worth more, all of that growth will have occurred in the Roth IRA, that growth being tax-free. All right, what's the fourth tax strategy to consider during down markets? We haven't had to think about this one in a while. It's been 4 years since we've had to think about it. Tax loss harvesting. And why wouldn't you have thought about it back in the spring or March of 2020? It was a flash in the pan, okay? We were able to do a lot of tax loss harvesting for our clients, but it was so quick. That was the shortest bear market we've ever had, followed by the best 50 days in the stock market ever. So if you blinked, you missed it and you weren't able to do tax loss harvesting. But the downturn in 2008, the tech bubble, 2000, 2001, 2002, those were some of the longest bear markets and declines we had in the stock market. And if this one goes the distance, and it's already pretty long for a correction, if we reached into bear market, it's already kind of getting a little long in the tooth here. You've got time to look and consider for your non-tax sheltered investments, for your joint account, your trust account, your individual account. Are there investments that you put in, you contributed this much, and it's now worth less, okay? So is there a capital loss that you could, capture on your tax return by selling this investment, reinvesting it into something else for at least 30 days, and be able to capture that loss, okay? If you're in a diversified portfolio, let's say a 60-40 mix portfolio, where you can rebalance, you can make a shift with your 60-40 portfolio into a similar 60-40 portfolio. It can't be the same thing, but a similar 60-40 portfolio, just using slightly different investments, and you'll be able to capture those losses on your tax return. Then those capital losses will offset any capital gains that you would have received either from mutual fund capital gain distributions or other capital gains that hopefully we'd see later this year. You'd be able to offset these losses against those. And if you have more losses than you have gains, you can deduct up to $3,000 on your tax return, carrying the rest of it forward. And then the fifth tax planning strategy consideration for down markets is choosing to fund your health savings account if you're eligible and choose to turn it into an investing HSA as well. We've done a lot of discussions on this. Makes sense for a lot of people. It makes sense for more people than are actually employing this strategy, okay? But your HSA, your health savings account, your contributions go in pre-tax. The growth, if you have growth on that account, is all tax sheltered. And then when you would pull those dollars out and use them for qualified medical expenses, you never pay tax on those dollars. Okay. If you are putting the money in your HSA and then spending it right away every time you have a toothache or every time you've got a bruise or need to go to the doctor or need some prescriptions, whatever, then that money is short term and you shouldn't be investing it. But if you've got enough cash flow, enough other resources where you can pay for some of your medical expenses out of pocket, and therefore you won't need to touch your HSA every time you have medical expenses and you can save up your receipts, then your HSA can be positioned for longer term. And you can invest those dollars, and because, like I said, the growth comes out tax-free, it's a great time when investments are down. Even if they go down further, right? You can't predict the future, but it's a great time to invest your HSA so that whenever that rebound occurs, even if it's not for a couple of years, you will have more dollars growing tax deferred and tax free in that HSA. It's a financial planning strategy where you've got to consider your present financial position, your investment, your retirement situation as well. Certainly your tax planning, so it hits at least you've got to have a qualified high deductible health plan. So it hits 5 of the 6 areas of financial planning directly, okay? So don't employ this strategy without talking to a CFP first, but in a down market, may make sense for you to start investing your HSA. All right, so let's recap. When the market is not performing well, when the stock market is down, what are some ways for you to take advantage of that, capitalize on that with tax planning, okay? One is fund or pre-fund or overfund up to legal limits, right? Up to contribution limits, your retirement accounts. Max out that 401k as soon as possible. Max out that Roth IRA, or you've been thinking about making a Roth contribution, do it now, do it soon while markets are low. That's number 1. 2, consider switching from pre-tax contributions to Roth so you've got the eventual rebound occurring in a tax-free account. 3, do a Roth conversion. 4, look for opportunities to do tax loss harvesting of any non-IRA, non-tax sheltered dollars. And then 5th, consider making your HSA an investment HSA. All of those are just ideas. Which ones make sense in your situation? That's the work of your certified financial planner who's doing comprehensive financial planning, looking at all 6 areas of your financial life. Reach out to them. If you don't have one on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.